Real Estate and Mortgage Show, your go-to spot for everything home buying, selling, and financing on News Talk 580 CFRA.
Welcome back to the show, everybody. Hey, we got a question in from realestateandmortgageshow.com from Wilfred. Wilfred says, we have a new build closing early next year. The purchase price, including upgrades, is $836,000, but the bank has come back saying the appraisal was at $810,000. We were planning to put 20% down, but now we'll be putting less down to cover the appraisal difference. Are there any options for getting the appraisal amount higher so we don't need to cover the difference, or any other suggestions that could help?
Yeah, so one of the suggestions
Great question, though.
Yeah, it is an amazing question because I think a lot of people are feeling it now. I think a lot of people are feeling it more on the condo side. So, did a mortgage this week for a first-time home buyer who's buying a condo, and the default insurer comes back and says, Frank, we need an appraisal on this. It's like, what? Why do you need an appraisal on a brand-new condo? And I did a little research myself. I said, but they're all selling at that price. Why do you need an appraisal for? And with my pushing them a little bit, I got it changed to what's called a desktop appraisal. And they came back and they said, you're right, Frank. And a desktop appraisal is basically what I did, which is you look at comparable condos in the neighborhood and what they've sold for with the square footage, and it matched what she paid for it. So on a home like that, just because one bank does an appraisal and it comes in lower doesn't mean that I don't think you need to be stuck with that bank. My first suggestion would be there are other banks and or lenders that do what's called an AVM, which is automatic valuation method. And what they do is they plug your address, they plug your purchase price in. And in a lot of cases, I've had clients where they go to their bank says, nope, it's not worth that much. And all of a sudden, they come to me and I'll do the auto valuation. I'll do it lender with an auto valuation. And lo and behold, the value is accepted at purchase price. So I think that's the first step, is that just because one bank says that it's that way doesn't mean that the next bank. And it sounds like it's closing in the spring. So between now and the spring, that value could go up as well. But I would say this, if you are close to having 20% down, and the interest rate, typically you would get a better rate if you had less than 20% down, but the cost to get the default insurance far outweighs what the difference in the interest rate is. So it would be more expensive for you to put less than 20% down. So in this case, I would say, give us a call or try another bank to see if they would auto-valuate it, because then you would get the value and you'd be able to put the 20% down. And at that point, then you don't have to worry about the appraised value.
Or the default insurance.
Or the default insurance, which is very important. Again, I mean, default insurance is a critical piece of people getting into homes, and it does lower your rate. And Paul always says that sounds so stupid that somebody puts 20% down and they pay higher than somebody who puts 5% down. But, and I think we like to look at it with the hat of a consumer saying, wait a second, I'm putting more down. I should be getting a better rate. But you have to look at it from the lender's perspective. If you're paying for default insurance, that means they're covered. It's like default insurance. That means if you go under default, they have no risk whatsoever.
The bank has zero risk at that point.
Zero risk. The default insurer will cover it. So hence why the rate is lower. And then there's another method, which I won't get into, which is the way they package the mortgages and they sell them off. That's a different thing, because if they're insured mortgages, that's why they were able to give better rates, because once they sell them off, they're much more attractive to an investor. And usually in most cases, it's a capital fund from the bank or anything. So
we probably saw more of that happening maybe over the last couple of years than we're seeing. Maybe we're in a solid year this year, but in the last few years, we've had a tougher year coming out of COVID when prices were super high.
Yeah. And rates were higher.
And rates were higher and values were starting to come down. I could see it more then, but we're on the uptick right now. Like we're definitely on the uptick. I mean, at the end of COVID, our average sale price was $745,000. We're now at 700,000. So we've definitely come downhill a little bit. So from the time it went from 745 in 2022 till now, we have seen a little bit of a drop, and we've seen some softening of prices and some flattening of prices. So I bet you would probably deal with that a lot more over that time frame than I believe right now. We're on our uptick right now. Like we're starting to go back up that hill, which is good news.
Yeah, and I've been worried in 2025 about mortgage renewals, because anybody that bought a house in 2020 or before has seen tremendous increase in the value of their home. Therefore, they built some equity up. Anybody that bought in 2021, specifically in the first 7 or 8 months, when their mortgage comes due in 2026, will also see some pretty significant increase in the value of their home. Therefore, they built some equity. On top of that, if they got a mortgage rate at 1.49, most of the payment was going to principal, so their balance came down quite aggressively, which is good news because then you're in a position where, if you have to tolerate a higher rate, there's an opportunity potentially to be able to keep the payments the same by just increasing the amortization. Now, most banks and lenders will say, nope, we're going to give you this rate as long as you keep everything the way it is. But if you increase the amortization, it's considered a refi, and therefore you need to pay the legal fees. We need to do an appraisal. You need to requalify.
You're basically going through the process.
You're going through the whole process again. And in some cases, people have to do it because they've got some outside debt. They're barely making ends meet, and all of a sudden for a payment. Now, again, I want to reemphasize, and I know we've done it many, many times, and we got to continue to do it. Just because your interest rate goes from 1.49 to 3.89 doesn't mean that your payment goes up 2.25 times. Right. That's not the way it works. Because a mortgage is amortized over a long period of time, that payment is capitalized over that period of time. Therefore, the payment doesn't go up quite as aggressively as people think. So, again, there's lots of people that are nervous that, oh, my God, if I'm paying $1,800, now my payment's going to go to $4,000 a month. I can't afford $4,000 a month. No, your payment's likely going to go to $2,200 or $2,300. Still significant, but certainly not double what the interest rate does. So,
right.
So that's a key point.
So what options are out there for people that are a little nervous about that?
As long as you got equity, as long as you've got equity built in, you can go back up to a 30-year. If you've got 20% equity in there, you can go back up to a 30-year amortization. So therefore, you can manage to keep the payments the same. And people say, but I don't want I need to. I want to tackle my mortgage. And I say, I agree. If you can absorb the higher payments,
do it.
Awesome. Yeah. Awesome. Keep your amortization the same. But if you've got outside debt, that means you're living beyond your means already with a low interest rate. And now your payment's going to go up $500. Now you're going to start to increase more outside debt, which is at a much higher rate.
Right.
You're better off to take all that debt, put it in there, try to get the payment to a level where you're comfortable, where you don't have to accrue any outside debt moving forward. That's the number one thing that I would say. So don't focus on the rate. Just because you can get 3.89 on a renewal, but it's going to cost you 4.29 on a refi, yes, you're going to pay more interest, but you're not going to have the outside debt, and the outside debt is significantly more expensive than that extra 40 basis points it would cost you to right. refinance instead of doing that.
When we talked about this before, I think it was Sherry was in. I think actually one time you were in, for the one time you were probably in, But we did talk about this, that yes, your payment potentially is going to go up. And for some people, $100 a month is significant. For some people, it's not. And with the way things are in the world today, how expensive things are in the world, for some people, $100 a month, $200 a month, $300 a month is crippling. And that's why I think there's so much pressure on these rates to come down, because as we get near into 2026, and in my opinion, even worse in 2027, when these mortgages are coming up for renewal, we got to get these rates down, because there's going to be some people that are going to be in a little bit of trouble, I think. Good to hear that they've built so much equity that, the rates aren't going to cripple them, but it's still going to be hard when those rates
27. 27 scares me much more than 26 does. 26, again, most people that bought a home in 2021, and, that's when we saw the craziness. But if they bought it the first 6, 7, 8 months of 21, they probably saw an increase in their value. The problem is, like you said, the average price was $745. Now it's $702, $700. So all of a sudden, they're a year away from their mortgage coming up for maturity. And if they bought that house with 5% down, yes, they got a good interest rate in early 2022, and they probably paid down some of their mortgage, but they're not in a position where likely they're at 20% equity likely.
Yeah.
And if you're not at 20% equity, now your hands are tied, because now you must remain in that mortgage. Now, if you got into a collateral mortgage, which is the good thing, is that a lot of banks do collateral mortgages. I used to cut them down. Now I think there's some benefit to them, because if you're in a collateral mortgage, you can transfer your mortgage from one lender to another and actually go back up to a 25-year amortization. And
so even if you've knocked 5 years off since,
as long as you're in a collateral mortgage.
Right.
So because a collateral mortgage doesn't have, so the difference between a collateral mortgage and a standard mortgage, if a bank registers a standard mortgage, it has a time frame. So if it starts at 25 years, that registration expires at the end of 25 years. If it's a collateral mortgage, it has no expiry date to it. So therefore, the ability is there now for Canadians who have a collateral mortgage that's coming up for maturity to increase the amortization back to 25. the likelihood is that the existing bank will say, nope, you got to keep the amortization the way it is. Otherwise, you got to go through all these steps. Where with other lenders, they say, nope, if it's a collateral mortgage, they transfer it to us. We can re-amortize it to 25 years, and we're good to go. They can just switch it over. So, again, do some homework. Don't get caught, and don't believe everything your bank tells you, because your bank is likely, and again, I was there for 22 years. The bank was teaching me what to say to clients, and I thought that was everybody. It was the same. And then I realized that they were teaching me what to tell clients and training me to tell clients what was in their best interest, what works for them to
What's
retain
good for the
clients.
bank's business.
We're starting to field those calls right now for those people that have bought in 2022, especially the start of 2022. I had when I was away, I had a call with a gentleman who potentially looks like he's going to list his home for somewhere around $100,000 to $130,000 less than what he paid for it, which is really that's a hit. And what we're seeing that, and my conversation with him was like, let's decide if you really need to sell, because this was an investment property for him, and I was trying to convince him that it might be better to keep it.
Hold.
But he was from out of the province. He was from a different province, and he just decided that it just doesn't want to do it anymore. But I'm like, you're going to take a big hit on this property. So if you're someone who did buy latter part of 2021, early 2022, and you don't have to sell, it might be wise not to sell at this point and sort of see what happens with the market. The good news is, like I mentioned earlier, we are on an uptick. We are on an uptick. Our market is rebounding. We're starting to see prices are going up. Inventory's coming down. I never want to go back to that COVID market. That was crazy and so unfair for a lot of people. I mean, sellers loved it, but keep in mind, a lot of people, when they're selling, they still have to buy. Right. Now, the people that really won are the people who are actually selling and then moving out of country or out of state or out of province. Sorry. So those are the people that loved it. But it's really, really tough if you've bought in those time frames and you have to sell and you bought in 2022. It's really, really tough. So let's have that conversation if you really have to sell at that point.
Well, you've always talked about real estate being a long-term game as well, not these quick hits like we see on the TV shows where you know.
Those things aren't even reality, right? Like, real estate's a long-term play. It'll always go up over time, and we've seen, especially here in Ottawa, we've gone down 5 times since 1956, and a couple times in 99 and one a few years ago. But other than that, we're steady Eddie. We're, anywhere from 2 to 4 to 5% every single year, steady Eddie. We're at 3%, our average sale price right now. We'll probably end similar to maybe around 3.5%, somewhere in that range. So Ottawa's Ottawa's a very stable market. We're going through a little bit of the shakes that everyone's going through right now. I mean, it's much worse in the States, I can tell you that. Like, just hobnobbing with these Americans, it's much worse over there. We're in a very, very fortunate position to be in a market like we're in right now.
Well, I think even separate from America, we're in a good position compared to markets like Toronto,
Vancouver.
Or Vancouver. Yeah.
Like, Toronto market right now is not great. I mean, their condo market's terrible. Vancouver's the same way. Vancouver's not good either, and that's what happens when you see markets that like scream up in price, they scream down in price too, right? So whereas Ottawa's not like that. So we're very fortunate. But Ottawa, as a whole, if you look at Canada and you look at Ontario, as a whole, it's not great numbers. But a lot of it is speared by Vancouver and Toronto. If you take those two out of the market, we're a very solid Canadian and especially in Ontario market, we're very solid. So
yeah, absolutely. Have a question? Head over to realestateandmortgageshow.com and submit it there, or give us a call, 521-TALK, 521-8255. We will be right back. Welcome back to the show, everybody. Hey, we got a call in from Tom in Ottawa. Tom's got a question about remodeling a kitchen before selling. Hey, welcome to the show, Tom.
Thank you.
Hey, Tom, what's your question? Thanks for calling.
I'm just wondering if it's, what I've been hearing is that new buyers aren't looking for projects. They're looking for a move-in, turnkey condition. And we're looking at downsizing and selling our house. The kitchen is a bit dated. It could use some updating. I'm wondering if it's worth investing in that before we market our house.
My answer to that would be definitely not. And I'll tell you why. One, kitchens are extremely expensive nowadays, and depending on what the value of your home is, if it's a real high-end home and you're going to put a higher-end kitchen in there, you could be anywhere from $40,000 to $80,000 into a kitchen. And what if you put a white kitchen in and the buyer wants a gray kitchen or a brown kitchen so I would let and now let me answer that as a buyer. If I buy your property, I want to do my own kitchen. So you would just have to price it accordingly, right? And when we go through the comparables, homes with newer kitchens probably have more value than you do. So depending on what you have. So what I would do is obviously I'd have to come see we're hearing beeping, aren't we? Obviously we'd have to come see your property to give you the straight answer. But I can tell you right now, 9.9 times out of 10, I'd tell you not to do it, to price it accordingly, because you never know if the buyer is going to like your choices. Now, if you told me we're going to sell in 5 years and you're going to enjoy your kitchen for 5 years, I'd say, well, then go ahead and do it. But if you're thinking of selling in the sort of the immediate future, I definitely would not redo the kitchen. Just price it accordingly.
Okay, thank you very much. That's very helpful.
You're very welcome.
And there's a program, by the way, that a lot of Canadians, we really don't take advantage of. It's called Purchase Plus Improvements. So if someone was buying Tom's home and said, you know what, I want to redo the kitchen, you can actually put an offer in on the property. Once it gets accepted, at the same time, if you can provide us with a quote of what the kitchen upgrade would be, we would submit both of those together. So let's say you bought the place for $600 and needed a $50,000 kitchen. We would actually submit it as a $650,000 purchase. And what happens is you get approved based on the $650,000. Now, you don't get the $50,000 up front. It kind of sits at the lawyer's trust account on closing. And then as the kitchen is completed, and on major renovations, so the one thing that we've noticed the default insurers do today and the lenders is that they're open now to doing draws. So it used to be a time when you had to finish the kitchen. Once it's finished,
Spend
let
the
us
full
know and you'll
50.
get the money.
Yeah.
Well, a lot of people don't have it, especially in a major renovation. So now you can actually take advantage of the draws, where if you get a third through it, we can send the inspector. It'll cost you $150 to get the inspection done. And then at that point, you can release funds as you go down the project. So, and usually it needs to be done in a 4-month period. So this isn't something you can add to your mortgage and take a year and a half to do. That's not the way the program works. The way it works, it's meant to be something that you can do in a 3 or 4 month period.
That was a great question, and makes me think, how many people actually go ahead and do things like that before getting us through the door, and it bites them in the butt? You know, like I've had people who have gone and done some of the weirdest renovations that they're like, well, I just put $50,000 into my backyard. I should be able to get that plus two times, right? No, you're not going to get that back. In fact, you're going to get the general rule of thumb for most upgrades is you're going to get about 30% of that upgrade back.
Right? On a pool, sometimes you don't even get anything back.
Well, a pool is neutral. I mean, when we were going through COVID, pools were super, super popular. But usually a pool's neutral. So you go put nowadays I say $100,000, but that's not even a pool with landscaping.
No,
that's
exactly.
just a pool. You put a pool in and expect to get that money back. What if I'm coming through my house and I have young kids and I don't want a pool? So there's no value in that pool to me. Right. But for other people, yes, there's value. But before you do an upgrade, get us through the door. We'll tell you what to do. You know, I've had people who've painted their own house, and you can see paint on the ceilings. And you're like, you just spent $4,000 on paint for your property. It has to be redone. So if you're going to get us through the door, please get us through the door before you do any renovations or any upgrades, because we'll tell you what you should do and what you shouldn't do to increase the value of your home.
Well, and I think, like you said too, Paul, it's based on timing. If you're going to enjoy it for the next 5 or 10 years,
do it.
If that's your plan to sell, you're not looking to do it immediately. Then fine. But if you're going to sell in the next 6 months to a year, you're not getting that $50,000 price tag back.
No, you're like I said, general rule of thumb is sometimes about 30% of that value. So you put $100,000 in, you're probably going to get 30 back. So make sure you get us through the door before you do those renovations, because you'll be so disappointed when you've spent some of that money. You know,
and I agree with what Tom said. Is buyers aren't necessarily looking for a project.
100%.
And if they can move in and the house is spotlessly clean, even if it's dated, they're fine with that.
But you know what? I'd rather pay a little bit undervalue to be able to go in and do the kitchen of my choice than try to, pay something of value and be like, I don't really love that kitchen. It's not the color I would have picked. It's not the appliances I would have picked. So sometimes, but he was right. Like, buyers are picky, and they want everything done. That's why I said it has to be priced accordingly. You have to make sure a buyer wants to buy that house because of the price and willing to do that work, knowing they're going to put 30, 40, 50, 60, 70 grand into a kitchen.
I shot a house probably 17 years ago, and they put a red kitchen in right before listing it, and the house sat and sat and sat.
Well, because if it's a new kitchen, you hate to rip that apart. I mean,
100%.
when Petch and I bought our house we have right now, we like our kitchen. We don't love it, but it's also a brand new kitchen. So I'm not going to go rip that kitchen out. That's stupid.
I love your kitchen, by the way.
Oh, you do, eh?
I like when we film videos there.
But it's not my choice of cabinets, for sure.
Fair enough.
Not my color choice, for sure. It's a beautiful brand new kitchen.
Yeah.
But I would have done something different. But, if I would have had the option of paying 20, 30 grand less to rip out a kitchen and do it myself, I would have done that. Right.
Yeah,
So.
no,
And again, don't forget the Purchase Plus Improvement Program. Again, most Canadians don't know about it. Most banks won't tell you about it because it's labor for them.
It's a lot of paperwork.
They just want it in and out is all they want. Mortgage brokers are very, very open to the Purchase Plus Improvement Program. They do a lot of homework on it. They get taught how to do it properly. So therefore, if you're buying a house and you see something that you want to upgrade, look at that program.
Yeah.
At least ask and see and see what's involved in it.
Oh, awesome. All right, Frank, birthdays.
Yeah, I've got a couple. Again, thanks very much, Lisa, for doing the show, and her and Tony's youngest, McKenna, is celebrating her birthday. So happy birthday to McKenna. And my beautiful first granddaughter, Amelia, turns 2 next week. So she's getting 2 mentions. So 1 this week and 1 next week because it's her birthday next Saturday. So happy birthday to my beautiful Amelia.
It's her birth month.
It's her birth month. And
absolutely.
mine's the day after. So that was the best birthday gift that I ever got.
There you go.
Was getting
There
my
we go.
first granddaughter.
I just have one. Tomorrow is a 3-year anniversary for Jake Prescott from my team, and Jake was another one of those Tracy Arnett realtors that came over, so he's celebrating 3 years with the company. Hard to believe it's 3 years. I feel like
Amazing.
we just had Tracy in here, but so Tracy's next week, actually. So Jake's 3 years with the company. Happy anniversary.
All right, if you have a question before next week's show, send it to realestateandmortgageshow.com, and have an amazing week, everybody.
Thanks, and please continue to support local business and charities, everyone.